So, you're stepping into the world of day trading with a modest amount of money in your account, and your goal is to boost that balance as swiftly as possible. I totally understand the dream. Who wouldn't want to build a fortune and sail a private yacht to grab a slice of gourmet pizza in Italy? However, not everyone starts with a fat wallet. You might only have, let's say, $100 to kick things off. That's exactly why in this video, I'm excited to share my strategy to help you grow that small portfolio into something substantial, potentially even into $1 million success. Let's dive right in with one of the most crucial lessons I learned as a novice in trading: risk management. I know, risk management isn't the most thrilling topic, but trust me, it's essential, regardless of how effective your trading strategy might be. If your risk management isn't on point, it won't help you grow your account. Poor risk management can leave you in a worse position than gambling at a casino. Think of your trading account like a lifeboat. Each dollar is a passenger you have to protect. If you overload that lifeboat or try to navigate too many paths, it's likely to sink. If your aim is to truly grow your account, you need to prioritize longevity and consistent gains. Why is high-risk trading such a problem? It boils down to consecutive losses. Every trading approach will experience losing streaks, no matter how confident you are. If you face several losses in a row and you're risking 20% with each trade, well, let's just say your lifeboat is heading for the ocean floor fast. This is where the 2% rule comes in, a principle followed by many successful traders. The idea is straightforward: only risk 2% of your trading balance on each trade. Let's break this down with a trading simulator, starting with our humble $100. We'll assume a 60% win probability, securing 2 wins for every loss over 500 trades while risking 20% per trade. Now, here's the eye-opener. Despite having a 60% win rate, which means you're actually winning more often than you lose, the high risk could still obliterate your progress. Consider this: if you risk 20% per trade, your maximum drawdown could reach a staggering 90.4%. That means it's entirely possible to lose nearly 90% of your initial investment, just like that. Could you handle a 90% loss, even if your strategy is supposedly a winner? Let's rethink our approach. Sure, here's a revised version of the text in a more human-like tone. Not really, and that's just a 20% risk. Let's take a look at what happens when we bump that up to 50%. A total drawdown of 100% and an average loss of 99%. Not good at all. But if we stick to the same scenario, but only risk 2% per trade, we'd be limiting our potential loss to 15%. That's definitely a better approach. Now, I understand where you're coming from. If you're hoping to double or triple your account balance in a day, trading with 2% on a $100 portfolio isn't going to cut it, and even risking 10% won't get you there. Higher returns require taking on more risk, but here's the thing: risk tolerance varies widely. Some of you might be thrill seekers with a high-risk appetite, while others may simply want to multiply their money, hoping for millions from a small investment. For those of you thinking that 2% feels insignificant, I totally get it. However, if your goal is to grow your account steadily and efficiently, statistics show that adhering to the 2% rule is the way to go. When you stick to a 2% risk, you can endure many more losing trades compared to if you're risking 20% or even 50%. So if you're a fan of numbers and looking for real profits, the 2% rule is a smart choice. But just having solid risk management doesn't guarantee profits. That brings us to the power of compounding. To truly make money, we need to grasp this critical concept. Imagine rolling a little snowball down a hill. In the beginning, it's tiny, just like your $100 initial balance. But as you keep rolling it, that snowball picks up more snow and grows bigger. By the time it's halfway down the hill, it's substantial. Each roll adds more than the previous one because it collects all that previous snow. That's what compounding is about. Every little victory adds to the base for future gains. Let's break this down further. What if you're earning just 1% on your account every week? I realize that 1% sounds small and might not seem like much, but over a year, thanks to compounding, that totals about a 67% gain. So, A $1,000 account could grow to around $1,670 by year end, just off that tiny weekly gain. And if you could bump that to 2% weekly, your account could double in under a year. Do you see where I'm going with this? As that snowball rolls further down the hill, it could potentially turn into millions over time. It's not about hitting grand slams, it's about making consistent, steady progress. Remember that 2% risk management strategy you were skeptical about? Here's where it shines. By steering clear of major losses, you maintain that snowball's momentum day after day. Protect your investment like it's a treasure, guarding it from significant setbacks with everything you've got. Your priority should be to keep that compounding engine running strong. One major setback can derail our progress entirely. Let's make sure that doesn't happen. We've got our risk management sorted, and we understand the power of compounding. Now, let's dive into the exciting part. Discovering your edge. There are countless ways to do this, whether it's tutorials on YouTube, insightful books, or even tips from your Uncle Larry. Actually, I am Uncle Larry, but seriously, it's your choice. Personally, I prefer YouTube since I'm more of a visual learner. Plus, let's face it, that Uncle Larry guy can be a bit eccentric. I frequently post videos discussing strategies, all of which have some statistical backing. You can browse through those for a strategy that resonates with you, or check out other YouTubers' approaches. If you don't mind copying a bit, that is. What truly matters is that you test your edge for yourself. Select a strategy, head over to your charting platform, and backtest it. Ask yourself, what's the win rate? How many wins and losses did you see? Did it end up being profitable? These are essential questions you need to find the answers to. If you're unsure, get to testing. I know backtesting can feel like a chore. Nobody really wants to buckle down and work through it, but remember that snowball metaphor? Without a statistically proven edge, your snowball won't gain any momentum. This is a crucial step in nurturing your small balance. If you're aiming for those big dollar signs, you must put in the necessary effort and start testing. Once you've established a statistical edge or a verified trading strategy, it's time for the final step in your blueprint: journaling. But I'm not referring to a little Dear Diary, I made my first trade entry. I mean creating a structured system that lets you trace the history of your trades, entries, exits. Were they successful? If not, why did they fail? You should be able to answer these questions for every trade you make, but you might wonder, why bother? Take Conor McGregor, the UFC fighter, for instance. He once watched footage of himself and noticed his opponent subtly shifted his right hand before throwing a punch. He took that insight to the gym to practice countering that precise move. Fast forward to the fight, and in just 9 seconds, it all came together. The takeaway? If Conor had never reviewed the footage, he wouldn't have made that crucial adjustment. The same rule applies to trading. By reflecting on your trades, you might discover, whenever I trade out of boredom at 2 p.m., I end up losing. Or maybe, my most profitable trades occur when I ride trends rather than trying to catch the market at its lowest. Those insights can be invaluable, and much like Conor, you can only gain them by looking back at your trades. You don't need anything too elaborate. A simple spreadsheet or notebook will do the trick. Personally, I use a platform called TraderView. Sure, here's a revised version of the text with a more human touch. There's this really cool site where you can upload your broker statement, and it breaks down a ton of useful metrics for you, like tracking each trade, whether it was a win or a loss, and your overall profitability. I'm not promoting it or anything, just wanted to share something neat I stumbled upon. I'll drop a link in the description for anyone interested. Thinking about trading really brings up some feelings for me. Making money in stocks isn't just about rushing to get those fancy cars overnight. Sure, that can happen down the line, but in the beginning, it's really all about finding your edge, steadily refining it, and keeping that momentum going. Plus, it's crucial to keep tabs on your progress. This journey isn't for the faint-hearted. You're going to face losses, and there will definitely be days when you start to wonder if this is really for you. There will be nights when your account is in the red, and all you have left to lean on is your faith in your strategy. But here's the thing. If you really stick to these principles in your trading, I can assure you that your small account will grow.